Hello and welcome to my video about 21 financial technology trends for 2021. I am David Gyori and my primary activity is to train bankers all over the world about FinTech, about financial technology. I am co-author of 5 books about financial technology. I have trained bankers and given keynote speeches in about 50 countries in the past 5 years. And I am on the list of top 50 global thought leaders on financial technology. Thank you for your attention. So, today we will go through 21 upcoming trends because of the year 2021. Trend number 1, the third generation of FinTech. What is the third generation of FinTech? The first generation of FinTech was represented by companies established before the 2008 financial crisis. A great example is PayPal, started up by 5 guys, among them Elon Musk, in Palo Alto, in Silicon Valley, in California, back in 1998. So the success story of PayPal with its current CEO Dan Schulman is a great example of a first generation FinTech company. The second generation of financial technology companies is represented by 99% of currently active operational up and running FinTech startups, FinTech companies, FinTech unicorns, FinTech decacorns. So 99% of the currently active financial technology companies, these are the companies established after the 2008 financial crisis. A great example, very successful example, is TransferWise, started up in very late 2009, very early 2010. We can say it was started up in January 2010. Look at TransferWise. By the way, it's always important to compare first generation companies to second generation companies. And the post-COVID generation of financial technology companies will be the third generation. This third generation will consciously follow the principles of Clayton Christensen regarding disruption and disruptive innovation, as opposed to first generation companies represented by dreaming, like visions, and second generation companies represented by hopes, principles, and an ethelon of better banking, born out of a crisis, the 2008 financial crisis. So this new post-COVID generation of financial technology emerging in 2021 will be much more rational, much more cold-blooded and cool-headed, and much more short-term profit-oriented, much more focused, much more razor-sharp, with much less dreaming hopes and ethical visions, much more pragmatic. Trend number 2, higher interest rates, the renaissance of balance sheet banking. So, How will we get to a brand new normal? Well, back to the old normal from the new normal of zero rates. How will interest rates go up? You see that most sovereigns, most countries, most states around the globe are taking on some debt. They are overspending in this COVID period. Obviously, tax revenues went down while the economy needs to be everything unchanged, stimulated on a fiscal macroeconomic basis. Now, if all sovereigns, this is just theoretic, are taking on additional debt at an additional dynamism, that will lead to higher interest rates. The balance of demand and supply of sovereign debt will have to move to a new equilibrium, and this new equilibrium will be represented by higher nominal interest rates and potentially higher price dynamism as well. But let's now focus on a higher interest rate environment. If interest rates are different from the zero rate paradigm representing the past 12 years, that will bring different models, different optimum, different equilibrium to the winning model of financial services. Specifically, interest rate margin will start to play a more significant role during the year 2021. If you want to earn money by this interest rate margin, as a bank for example, you have to play consciously, actively and in a professional way on both sides of the balance sheet. This is how you can create an optimal position of taking advantage of interest rate margins. Most financial technology players are only focusing on one side of the traditional banking balance sheet, only assets or only liabilities. The renaissance of traditional balance sheet banking will come to us during the year 2021. Trend number 3. Valuations and profitability will be linked again. What am I talking about here? In trend number 2, I have already derived the way our world will move into a new equilibrium of higher nominal interest rates. In this environment, obviously, the role of profitability versus growth will be rebalanced. Prompt or short-term or mid-term profitability will start to play a much stronger, much more important role than it used to play before in a de facto zero-rate environment. Why? Because the base rate is basically the time value of money. And if the time value of money, theoretically speaking, is zero, then future potential profitability in a nominal US dollar term equals the value transformed back and incorporated into corporate valuations of prompt, immediate profitability. However, if nominal interest rates are significant or significantly high, then present prompt, immediate or short-term nominal US dollar denominated profitability has an amazingly higher value, exponentially higher value than future potential profitability 3, 5, 7, 10, 12 years down the road. This principle, in a higher nominal interest rate environment, will rebalance the valuation of tens of thousands of financial technology startups, unicorns, and even some decacorns around the world. Trend number 4, data ecosystem strategy. The amount of data registered, stored, analyzed, circulating, produced, the volume, variety and velocity of data around us is growing, and it's basically growing exponentially. Data is probably the new central resource of a post-industrial capitalism. It's almost like a new central commodity, replacing carbohydrates, replacing oil and gas. However, data is very different from oil, as a matter of an example. What's the difference? 2 barrels of oil are 2 barrels of oil. Oil is additive. However, the value of 2 units of data is often higher than the sum of the value of 2 separate units. Imagine putting the information together that it's gonna rain tomorrow and I don't own an umbrella. If we put these 2 separate pieces of information together, it immediately becomes obvious that someone has a serious chance to sell me an umbrella, even at a premium price level potentially. And we can come up with thousands and millions of examples like this within financial services and beyond financial services. This is what I call data synergy. If 2 different owners, 2 different entities owning, handling, gaining data, put their knowledge together in an application, in a customer-facing solution, in analytics, in planning, in advice, this can create significant synergies. This is the deeper, and this is the deepest engine. This is the ultimate source of momentum behind PSD2, Payment Services Directive 2 in the European Union, behind open banking in the UK and in more and more and more parts of the world, for example Australia. And this is the engine behind the incredible success stories of third parties in banking, API, application programming interface, infrastructures. Data plus data is more than 2 times data if you play it smart. Therefore, you need to build an ecosystem. Think about DBS Bank in Singapore, the market-leading retail bank in Singapore, a very innovative retail banking market. How they are consciously building a data synergy ecosystem around themselves with the very smart strategic leadership of their CEO Piyush Gupta. Anyway, trend number 5. Fear of Singleton of GAFA banking. We have to first clarify two terms here. GAFA. GAFA is an abbreviation standing for Google, Apple, Facebook, Amazon, the four large technology giants from the United States. But what is a singleton? A singleton is a theoretic creature propelled by AI, artificial intelligence, providing superpower, supremacy to one entity, a nation state, a large corporation, or whatever. Now, as we are entering this era of data as a central resource, you have to think through who has more data about you, Facebook or your bank? Facebook or any financial services provider? Google or any financial services provider? Who knows more about you? Try to download all the information Facebook has about you and you will be surprised how much and how smart and how detailed and how important, meaningful things you are permitting Facebook to know about you. Well, in the past 20 years, banks have lost their kingdom of data excellence. Now technology companies are much more rich than banks. Well, not in terms of their total assets and liabilities on their balance sheets, but in terms of the data wealth they have access to, in terms of the data wealth they are owning. This data, very, very, very much data, and very, very rich data, this is the primary input to artificial intelligence. Artificial intelligence, played well, can harness the superpower of machine learning done by deep neural networks of nonlinear artificial neurons, what we call deep learning. Deep learning and the increasingly active entry of United States technology giants into financial services, think about the recent moves of Google, put together can create at least the theoretic fear of a superpower emerging and de facto owning a very serious share, 1, 2, 5, 10, 12, 15, 20% of all financial services globally. By the way, this monopolistic centralization of this power is very much related to the data synergy, the phenomenon of data synergy, which we talked about under trend number 4. But anyway, this fear will rise during the year 2021. I think this fear initially, later down the road, will fail to materialize. Still, I am listing it as a trend because the fear itself of technology giants or other players gaining through data supremacy and through supreme powers propelled by artificial intelligence, deep learning, machine learning, and so on, this fear of gaining huge competitive advantage will be there on the table. Trend number 6. Surge in M&A, mergers and acquisitions, and hostile takeovers, and corporate venture capital activity, whatever. So, the current COVID situation will shake the market up. As we have discussed under trend number 2, we will move to a higher interest rate environment. This will totally change the position of different financial technology players in relations to different traditional financial services players, and this will create a never before seen dynamism of mergers, acquisitions, takeovers, corporate venture capital activities, buying and selling, by the way, spinning off and acquiring in terms of equity as well in the market. I am very much looking forward to this. In my mind, there are different optimal combinations, like which bank should buy which fintech may make a move on which traditional bank, and so on. There are many different combinations. Which large global payments company will merge with which other global payments company. Okay, trend number 7. Optichannel instead of Omnichannel. Omnichannel refers to being perfectly excellent across all available banking channels at all times in all verticals, vectors, dimensions and aspects. It takes huge resources. There are some banks in the world, international players, having nearly 100,000, you hear me well, nearly 100,000 full-time equivalent employees in IT. And still, with 100,000 full-time equivalent employees in IT, they are unable to reach anything like the theoretic ideal of omnichannel. Therefore, the new paradigm will be Optichannel. The number of channels is growing, old channels are remaining with us, while new channels are coming to the picture day by day, from voice to Instagram, from extended reality to AI-propelled chat, from CGI computer-generated image assistants serving the clients to virtual reality branch solutions, and so on. The number of channels is growing fast, monotonously. The old channels are staying with us while new channels are coming into the picture. So the cost, the complexity, the need for more and more and more IT people to maintain any sort of ideal of omnichannel will be higher and higher and higher. So we will move to Optichannel, which means that a smart bank will consciously, proactively limit the number of channels to 5, 10, 15 instead of 40, 45, 50, 70. Think about a large universal bank. And start to count the de facto channels, you will be very surprised. So a limited number of channels will be perfectly integrated and coordinated with each other, and this will exponentially reduce the costs while it will add to the perceived quality of services by clients. Trend number 8. Immersive banking. Through 5G and later, very soon, 6G mobile communications paradigm, a new dimension will open up. Augmented reality and virtual reality during the year 2021 will seriously start to come to the market. Watch the smart glasses of Apple coming out, and later some amazing VR hardware, software solutions will emerge during 2021. This will open up a whole new discussion about spatial computing in financial services, immersive banking experience, and whatsoever. Keep your eyes open. Amazing things are coming, and some players are already there serving niche verticals. For example, Alipay is very active in VR pay, virtual reality payments, but much more is already there, and it will multiply exponentially in the coming month. Trend number 9, cross-convergence of branch strategies. What does this mean? It's very simple in reality. My prediction is, and in January 2022 we can decide if I was right or wrong. So my prediction is that some neobanks, some digital-only banks, some mobile-only banks will start to open up a restricted, very much restricted, branch network. You hear me well. Physical branch network during the year 2021. Probably these will be branches already designed with the entire shock and experience of the COVID-19 period in mind. So the structure of these branches will be different, and the number of these branches will be very much limited with alternative functions. Still, this will be a shock to traditional bricks and mortar players. Again, very limited numbers. But still it will happen. Meanwhile, my prediction is that a growing number of traditional incumbent bricks and mortar banking players out of the current approximately 25,000 active licensed banks globally will shut their branch network down entirely. They will eliminate all of their branches. Potentially 1 or 2 branches will remain. Again, I am betting on this in a limited number of cases. Still, it will be shocking when a mid-sized regional bank present in 12 European countries will announce that our apologies, and please, our shareholders, value it. We are moving now to a digital-only model. We will shut down our entire branch network during the course of 5 to 9 years ahead of us. Some players will play it actually faster, but we will start to hear about this. And one more thing will emerge: multi-brand branch. Think it through, okay? Instead of going into details, I am moving to trend number 10, gamification and gaming. Well, financial services providers traditionally have a difficulty to attract the young generation. What is the language of the young generation? Computer games, smartphone games, online games, gaming is the language of the young generation. So when you want to attract them, you have to gamify financial services. Imagine the instant generation. What is the instant generation? Millennials and Generation Z. They want everything immediately, instantly. Imagine the instant generation having to type in things, sharing data, spending 5 minutes to open up a bank account. 5 minutes is unacceptable. They like to do things one click. or 2 clicks or 3 clicks, but you cannot open up a fully functional AML, KYC, CTF compliant bank account just by clicking 3. So you have to find a way to engage this generation longer and deeper, and the answer is gamification. On the other hand, more and more banks will emerge, digital-only players, digital specialists, neobanks, with gaming background. Think it through. There are already serious financial services players globally having a background in computer gaming or smartphone gaming, and more of this will come. Trend 11, health and wealth. Well, think through the entire core lesson of the COVID-19 situation. This lesson is about the value of our health, how important it is, how central it is. Between the COVID crisis and the 2008 financial crisis, de facto between the years 2008-9 and 2020-21, the core focus was on financial health. Okay, all right. But this unfortunate, sad COVID period taught us that we also have to focus on physical, medical health as well. Well, through smart sensors, through Internet of Things, through 5G protocol, through biosensors, these two trends will come closer and closer to each other. There will be many successful applications intertwining these two. Imagine the power of financial health and medical health intertwined into one ecosystem, one device, one environment, one application of sensors. Trend 12. Robo-advisors of Betterment Style. Well, the traditional wealth management market in the United States has already been disrupted. Sorry Vanguard, sorry Morgan Stanley, but robo-advisors of Betterment Style have gained incredible role, serving an ever wider and more important layer of the society. In Southeast Asia, meanwhile, robo-advisory solutions are fairly successful. I want to see, and my prediction is that we will see almost the same level of success step by step unfolding within the European market as well as Africa. This will be very interesting. By the way, as the African middle class is surging and rising, this will become the #1 tool of wealth management in this environment. But again, in less emerging, more affluent European countries, Betterment Style robo-advisors have a great future, and this trend has to come and materialize. Number 13, social trading. Think about eToro, the company from Israel. It's amazing. There are more than 5 million, nearly 10 million actively trading young people. Social trading, copy trading is basically the social media of stock trading, asset trading. It's a whole new environment with beautiful side effects and aspects on top of risks. One thing is sure, social trading, copy trading, many other companies are doing it besides eToro. will gain more momentum and much more media attention and awareness from the well-established incumbent players during the year 2021. Keep your eyes on social trading, copy trading, or even specifically eToro. Trend number 14. Crypto crisis of complex compliance. I am a great crypto pessimist. In the midterm, I only see one or two segments of digital currencies staying with us in a traditional compliant environment, and that is one of them is CBDC, central bank digital currencies. Another one will be some sort of transactional environment for corporate transactions. That's a different story, and it would take a lot of time to explain. So let me focus on why the vast majority of the currently globally circulating 2,000 to 4,000 coins will have to probably potentially disappear. My prediction is this. In trend number 2, you have heard about a higher nominal interest rate environment. Now, there is one thing. When you hold Bitcoin or Ethereum or other typical cryptocurrencies, usually you are not receiving traditional nominal interest gains in return. And the reason for this is that in order to receive safe interest rates, returns on your crypto deposits, there should be a monitored, risk-managed, compliant crypto lending landscape. The two sides of the crypto balance sheet should be in balance and connected in a safe, transparent, professional way. We are not there. Therefore, when you can receive significant, nominal, de facto risk-free interest rates on your fiat currency, traditional, national, sovereign currency, denominated bank deposits, all of a sudden these crypto things will lose some momentum. What will be the instinct, what will be the reflex to create environments with both sides of the crypto balance sheet, i.e. clean crypto banking? And this is where authorities, regulators, lawmakers, KYC, AML, CTF related monitoring activities will come to the picture. And at this point, monetary authorities, sovereigns, in monetary history, usually these great innovations end up in a more controlled environment. Well, I am speaking softly here. Okay, trend number 15. Asset tokenization in corporate finance. While I am very pessimistic about cryptocurrencies in general, what I see coming is that more and more corporates, not startups, not little innovative projects, but well-established, famous, strong branded corporates will go into some sort of legally organized, due diligent, trustworthy, transparent, monitored, safe avenues of crowdfunding and de facto asset tokenization, from football clubs to famous music bands, from some early moving corporates to some more innovative, less risk aversive players. I am already seeing this trend. So asset tokenization will probably move to the other end of the scale, from the very tiny startup, innovative, risky projects. Some of them are even partially, potentially fraudulent or non-compliant, to the well-established large corporates. So asset tokenization goes to corporate finance environments. Trend number 16, shift from compliance to cybersecurity. Well, following the 2008 financial crisis, there is a strong suspicion that financial services have been, in general, over-regulated. By the way, the FinTech ecosystem is the example against this, but still well-established traditional bricks-and-mortar incumbent large financial institutions have probably been somewhat over-regulated. The pendulum went the other way. And after this COVID situation, this sort of compliance will probably play slightly less role, and even more attention will move to cybersecurity. Even the concept of cyber compliance will emerge and start to play a primary role. So being secure and safe in terms of cyber security will partially overtake the importance of material financial legal compliance. Trend number 17. In my prediction, 2021 will be the year when a credit cycle will unfold in China. Think about the NPL, non-performing loan rates, default rates, provisions of certain banking entities in China. I believe China will go through this credit cycle relatively healthy. I think that this Chinese credit cycle is in the pipeline. However, this Chinese credit cycle will open up new avenues. In fact, it will backtest, stress test many of the artificial intelligence driven risk management algorithms developed in China in the past 10 years. We will see how these algorithms are performing. However, this credit cycle will be an opportunity to put much more and much more diverse data. You need default to create a good model. It's not enough to have well-performing loans. You also need a significant amount of defaults to create good models. And meanwhile, this credit cycle will motivate Chinese financial services decision makers to open the market, everything unchanged, a little bit more up. And that will be amazing. That will be a win-win. Trend number 18. Visa and MasterCard will begin to feel the heat. Well, there is a lot going on in payments. More and more countries around the world are having de facto free, I am exaggerating here, I am simplifying here, de facto free, de facto real-time, I am simplifying and exaggerating again, local currency denominated local clearing systems. Now, once it's given this sort of clearing system. Having a card in payments contexts, basically technologically, financially, and in terms of logic, physical logic, loses its sense. Mobile wallets on steroids will emerge in 2021, and bank account to bank account payments in physical commerce as well as e-commerce as well as mobile commerce will take central stage. Visa and MasterCard, think twice where you are moving. Trend number 19. Multifactor identification, digital identity, identity in payments. These are very, very, very tough topics. Customer experience, less friction versus more certainty in terms of identifying who is doing what. Identity fraud, stolen identities, card fraud, payments fraud. All these topics are very important. What I see emerging is a continuous identification, a constant, permanent identification of a human entity in a digital environment. The combination of not one factor or two factors or three factors, but multiple factors and layers of security, basically not making identification a spot action, but identification a continuous state of existence, are in the pipeline. From heartbeat through smartwatch or smart ring to your iris when you are sitting in front of your laptop or tablet, from your fingerprint to your keystroke, many layers of your behavioral pattern, your IP address, your browser history, and I could go on and 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 on. But multiple factors of continuous identification will reduce friction in payments and in online digital use of financial services, while at the same time providing an objectively higher level of security all in all. Think about putting your phone in your pocket and walking down the street. The vertical and horizontal series of movements of the gyroscope of your phone can quite well identify you. Why? Because gait, the way people walk, is individual. Anyway, multi-factor continuous behavioral biometric complex identification. Trend number 20, Metatechnologic state of banking. What is this Metatechnologic state of banking? Technologic state of banking is recognizing the 30 major trends of financial technology emerging with approximately 2,000 subtrends. However, as a bank, you have to go a different way. You cannot run 2,000 projects of transition. You cannot run 2,000 projects about technology. These technologies are changing very fast. Most of these technologies are exponential. So you, as a traditional bank, or as a matter of fact, even as a challenger, a disruptor, a financial technology player, you need something different. Instead of specific technology skills, or on top of specific technology skills, you need something different. The winning thing, the winning element, the winning cocktail is to be in the Metatechnologic state of banking, which means that your bank is able to adjust to upcoming new technology trends, unknown upcoming new technology trends in a very flexible, very swift, very natural, very cheap, very easy way. So this is a new concept of organizing your bank, managing your bank, setting up your processes, setting up your technologies. The winner will not be the bank with the better core banking system today. The winner in 2021, 2022, 2023, 2025, 2030, 2040 will be the bank with the better skill to safely, naturally, quickly, cheaply, and in an intelligent way change the engines mid-flight. Go to a newer and newer and newer core banking system. This applies to all the software spaghetti within certain banks. Trend number 21. To close the 21 FinTech trends for 2021 with something little bit more creative. Exobanking, space banking, banking in the space. 2021 will be the first year when we will hear again and again about the concepts of transacting from the space, opening a bank account as a space tourist, opening a virtual branch on a space station, starting a colony on Mars or Moon. It will not happen in 2021, but we will start to hear about finance fiction as opposed to science fiction, or within science fiction. So finance fiction, space banking, exobanking will slowly become a thing, and keep your eyes on it. It will have beautiful theoretic and even some practical lessons to gain. So, these were my 21 financial technology trends for 2021. Please sign up to my YouTube channel, and please also sign up to my Facebook group under the name Banking Transition with David. Whatever you are up to, please be profitable. Sorry, this is the tagline of Richard Quest, but I am David Gyori, so my way of saying goodbye to you is, whatever you are up to, please stay healthy and wealthy in the year 2021. Thank you for your attention. Sign up to my YouTube channel.